All right, let's talk about some really big changes that are coming down the pipe for Social Security in 2026, because there's a fascinating and kind of tricky puzzle baked right into them. So here's the big question. How is it possible that a bigger Social Security check could actually end up costing you money? It sounds totally backward, right? But for millions of retirees, what looks like good news could actually trigger a much bigger tax bill. So let's unpack this whole thing. Okay, first things first, let's look at the two changes that are going to directly hit your monthly Social Security payment. You've got a little bit of good news and, well, a little bit of not so good news to go with it.
So on the plus side, it looks like beneficiaries are going to get a 2.8% cost of living adjustment, or COLA, for 2026. And the whole point of that is just to help your benefits keep up with rising prices. So far, so good. But that little boost gets eaten into almost right away. You see, the standard premium for Medicare Part B, the part that covers your doctor visits and things like that, it's set to jump by nearly 10%. For most people, that means an extra $17.90 is going to come right out of that Social Security check every single month. And this table really puts those numbers into perspective. Take the average retired worker. That 2.8% COLA sounds nice, right? It's an extra $56 a month. But once you subtract that Medicare premium hike, their actual gain gets slashed by about a third. And we haven't even gotten to the taxes yet. All right, now for the next piece of this puzzle. There's a new law that introduced a pretty major tax break just for older Americans. And this is where things start to get really complicated. So on paper, this senior bonus deduction looks amazing. It's a temporary break that's going to run from 2025 through 2028, and it could potentially let you shield a serious chunk of your income from taxes. But, as with pretty much everything tax-related, the devil is always in the details.
And here it is. This is where the trap really starts to form. See, this deduction isn't for everybody. If your modified adjusted gross income, your MAGI, is over $75,000 for a single person, that bonus starts to shrink. And as your income goes up, this powerful tax break just fades away. You have to remember this phase out. It's the trigger for the tax torpedo we're about to talk about.
Okay, so let's connect the dots here. Let's see how that little COLA increase, when you combine it with your other income, can create this hidden tax trap. Financial planners have a nickname for it, and it's a good one: the tax torpedo.
The entire trap is built around a special little calculation called provisional income. And you need to know this number exists for pretty much one reason and one reason only: for the IRS to figure out how much of your Social Security benefits they get to tax. And here's exactly how they figure it out. It's your normal adjusted gross income, plus any tax-free interest you have, plus, and this is the absolute key, 1/2 of all the Social Security benefits you got that year. Now, once your provisional income crosses certain thresholds, a chunk of your benefits suddenly becomes taxable. And here's the truly shocking part. These income thresholds, $25,000 for singles, $32,000 for couples, they haven't been adjusted for inflation since they were created decades ago. That means every single year, more and more retirees get sucked into this tax net. So why the dramatic name? Why call it a torpedo? Well, financial pros use that word because of how quickly and devastatingly it can blow up your tax bill. It's not some gentle, gradual slope. It's a sudden, steep cliff that can just sink your finances. So here's how the torpedo strikes. Let's say you take $1 extra out of your 401k. That dollar doesn't just get taxed. Oh no. It also forces 85 cents of your Social Security benefits to become taxable too. So if you're in the 22% tax bracket, the tax on that $1 extra isn't 22 cents. It's almost 41 cents. That's a hidden tax rate that can actually be higher than the top tax bracket for the wealthiest people in the country. But wait, there's more. This whole income puzzle gets even more tangled if you're a retiree who is still working. Because on top of the tax torpedo, there's a whole other set of rules you've got to know about called the earnings test. This is the earnings test. Now, your full retirement age, or FRA, is usually around 67 these days. If you claim your benefits before you hit that age and you keep working, you can only earn up to about $24,500 in 2026. For every $2 you earn above that limit, Social Security will temporarily hold back $1 of your benefits. Now, the limit gets higher in the year you actually hit your FRA, and then it disappears completely once you're past it.
And it's not just about retirees. The system is also taking a bigger bite from high-earning workers. In 2026, the maximum amount of income that's subject to the Social Security payroll tax is going to climb to $184,500. So you can really see how the system is being tweaked from both ends. So after you wade through all these different currents, the COLAs, the premiums, the new deductions, the tax torpedoes, what's the big picture? What does this all really mean for the future of your retirement? The most important thing to take away from all of this isn't some specific piece of financial advice. It's about empowerment. Just knowing that these complicated rules, these phase-outs, and these benefit cliffs even exist is the absolute first step. It's what allows you to start asking the right questions and planning ahead. And that leaves us with one final, pretty provocative thought. We all know the Social Security system is under some long-term financial pressure. So the question is this web of complex tax traps and phase-outs just a weird byproduct of old rules? Or is it becoming an intentional feature of a system that needs to claw back money any way it can? That's the big question we'll all be watching in the years to come.